Do you know what the most widely traded vehicle on the planet is? It's not gold, and it's not oil either. And while stocks may draw a lot of interest in the financial media and from retirement planners, it's not any single stocks either. The most widely traded vehicle on the planet Earth is the euro-dollar currency pair. This is the currency pair created from the exchange rates of the world's two largest economies. If a European country wants to make an investment in U.S. treasuries, they're likely going to need to make a trade in the euro-dollar first. Or likewise, if a U.S. company wants to buy Greek bonds, well, they would need to first buy euros with their dollars so they can make the whole transaction happen. This massive liquidity can provide quite a few benefits to traders. Trading costs can be significantly lower, often a few hundredths of thousandths of a cent between the buy and the sell prices. These price deviations can be so small that they have their own name, commonly referred to as pips, which stands for percentage in point. Throughout the day, prices move up and prices move down, but the difference between the buy and the sell price, this functions like your commission on a trade. And in this example, you'll see a spread of 2.5 pips on the euro-dollar currency pair. But all of this extra liquidity doesn't mean that the euro-dollar is any easier to trade than in these other markets. Many of the same principles apply whether we're trading currencies or whether we're trading stocks or futures. Price movements can be unpredictable, and trading in any of these markets brings us the potential to lose money. As such, it's often best to focus our trading activities in a manner that can be conducive to our long-term success. So on the euro-dollar, prices move 24 hours a day, Monday through Friday. The market never closes. But the period of the day in which Europe is open before the United States, between 3 a.m. and 8 a.m. Eastern Time, can often be best for trading in the euro-dollar market. Once the United States opens, prices begin to be quoted on both sides of the Atlantic, and this can create rapidly volatile price movements that can make it much more difficult for retail traders to speculate. Don't feel like waking up at 4 a.m.? That's okay. Most other traders feel the same way. And in the FX market, we have a litany of tools that can allow you to trade in these markets without you needing to press the trigger for each and every buy and sell decision. We'll talk about that more in a moment. Volatility is something that needs to be expected in the euro-dollar. With a representation of the world's two largest economies, the euro-dollar can often bring wild and extended price movements. This leads many traders to focus on trading what are called breakouts in this currency pair. A breakout takes place when price makes a new intermediate term high or low. The strategy employs an element of Newtonian logic in expecting things in motion to tend to stay in motion, and using the presumption that prices making new highs or new lows will continue on to make further highs or further lows. And if price doesn't go on to make higher highs or lower lows, a tight stop can be used so that the trader can exit the trade at a minimum of a loss. But if prices can continue running, the potential reward could be huge relative to the amount of risk taken on. At DailyFX, we teach traders how to look for breakouts, what may cause them, when they might happen, and maybe more importantly than that, what price levels to generally look out for. We also provide trading signals on a variety of strategies, breakouts included, to assist you in trading in these market conditions. We even have automated strategies that you can apply to your account so that these types of trade entries can be made for you even while you rest soundly in your bed. Join us at DailyFX for more information on trading breakouts, the euro-dollar, or automated trading strategies.